Welcome back to the deep dive. Every now and then, the market throws you a curveball. Not one you'll miss entirely, but, one that makes you pause, squint a bit, and wonder, is this actually a home run waiting to happen?
Or is it going to break sharply and leave you swinging at air?
Exactly. And today, we're dissecting just such an enigma. Dynex Capital, ticker symbol DX.
Ah, Dynex.
We're talking about a 16% dividend yield, paid monthly. That's a number that immediately makes you sit up and say, okay, let's unpack this.
Right. And that's precisely the core question we need to explore for you today. Is Dynex's 16% yield a genuine gift for income investors, or is it, well, a hidden trap?
Because yield's that high.
They typically scream risk, don't they? So our mission today is to really dig into the source material on Dynex Capital.
Get under the hood.
Exactly. Help you understand the full picture, the appeal, sure, but also the mechanics, the red flags, the potential upside.
So you can decide what it all means for you.
Precisely.
Okay, let me set the scene for you. Imagine you're an income-focused investor.
Right.
You've probably got your portfolio sprinkled with dividend aristocrats, the Coca-Colas of the world, long history, rising dividends.
Reliable. Maybe some REITs like Realty Income, the monthly dividend company.
Yeah, exactly. And you're clipping coupons at maybe 4, 5, maybe 7% if you're feeling adventurous.
That's generally considered pretty good, solid income.
And then Dynex walks into the room, offers 16%.
16.
Oh, and by the way, pays you every single month, consistently.
That's the temptation, isn't it?
It really is. A 16% yield means, theoretically, for every $10,000 you put in, you're pocketing $1,600 a year.
And seeing it hit your account monthly, that's powerful.
It feels tangible. For retirees needing cash flow, that sounds like manna from heaven.
Or for more aggressive investors reinvesting those dividends.
It's like compounding on steroids. But, okay, here's where it gets really interesting.
Yeah.
How?
How do they do that?
How do they manage such a staggering yield when most are getting a fraction of that?
That powerful draw is absolutely undeniable. The promise of that much monthly income, it's incredibly attractive.
Especially now.
Right. But, and this is the critical point, that but is huge here. A yield that high inherently raises questions.
About sustainability.
Sustainability risk.
Yeah.
What is the market pricing in that makes that yield so high it signals caution?
So let's dig into the how. How does Dynex pull this off? It's not your typical dividend stock.
No, it's not owning factories or selling soda. Dynex Capital is a mortgage REIT, an mREIT.
Okay, so what does that mean practically? No shopping malls.
Correct. They don't own physical properties. Instead, they own paper.
Paper, yeah.
Specifically mortgage-backed securities or MBS.
No.
Think bundles of home loans or commercial property loans.
Right, like the stuff Fannie Mae and Freddie Mac deal with.
Exactly. That's residential agency. MBS agency-backed means the U.S. government essentially guarantees the principal payment.
Okay, so that sounds safer.
It removes the credit risk, yes. But they might also hold commercial MBS or even non-agency MBS, which don't have that government backing and are riskier.
Got it. So they buy bundles of mortgages.
Yeah.
How does that turn into a 16% dividend?
What's fascinating here is their business model. Mortgage REITs, fundamentally, they live and die by the spread.
The spread.
The difference between their cost of funds and the yield on their assets. They borrow money short-term, usually at lower rates,
Okay.
and use that borrowed money to buy higher-yielding, longer-term mortgage securities. They pocket the difference. That's the net interest margin.
Sounds simple enough, almost like banking.
Deceptively simple. The primary risk, interest rate swings. Big time.
Ah. Because if the short-term rates they borrow at it go up.
Exactly. If their borrowing costs rise faster than the yields on the MBS they hold, that spread gets squeezed, sometimes badly.
And profits disappear.
Or turn into losses. Now, Dynex does try to hedge this risk. They use derivatives and other strategies. But the source material we looked at likens hedging in this kind of volatile rate environment to using an umbrella in a hurricane.
Huh. Okay, so it helps, but maybe not enough if things get really stormy.
Pretty much. It can mitigate, but it's not perfect protection.
So how does that 16% dividend actually happen then? Just from that spread?
Well, two main drivers, really. First, significant leverage. They borrow heavily.
Meaning they use a lot of debt to buy those assets.
A lot of debt relative to their equity. This magnifies the return on their capital when the spread is positive.
But it also magnifies the risk if the spread narrows or turns negative.
Precisely. Leverage cuts both ways. The second thing is they occasionally issue new shares.
Selling more stock.
Yep. through things like at-the-market offerings. It brings in cash, which can help them buy more assets or, frankly, sustain the dividend payment.
But it dilutes existing shareholders. Everyone owns a slightly smaller piece of the pie.
That's the trade-off. So high leverage and potential share dilution are key parts of how that 16% gets paid.
Okay, so leverage, interest rate risk, dilution. It feels like we're naturally transitioning to the skeptical view here.
We have to. With a yield this high, you absolutely must ask you, the listener, to consider the significant red flags.
And they are significant. Let's start with the payout ratio.
Oh, boy.
Our source calls it absurd. And the numbers back that up. North of 280% based on earnings.
And over 500% based on cash flow. Think about that.
It's like spending $5 for every $1 you actually make.
Right. And just saying, don't worry, I'll borrow the difference or sell off little pieces of my house.
Eventually, people notice. You can't sustain that indefinitely.
You really can't. And it's not just the ratio. The company actually reported net losses recently.
In both Q2 and the first half of 2025, according to the source. They were losing money while paying out 16%.
That disconnect is troubling. It raises serious questions about where the dividend cash is truly coming from, if not earnings or core cash flow.
And then there's that share issuance we mentioned. They filed something called a shelf registration.
Which is just fancy financial speak for, we have permission to sell more shares whenever we need or want to raise cash.
So more potential dilution hanging over shareholders' heads.
Potentially, yes. It gives them flexibility, but it's a risk for existing investors.
And we haven't even fully circled back to interest rates yet, the big one.
The elephant in the room for any mREIT, if the Fed keeps rates higher for longer, as they say.
Dynex's borrowing costs stay elevated, squeezing that spread.
Exactly. And there's another rate-related risk. Prepayment speeds.
Meaning homeowners paying off their mortgages early, like refinancing.
Right. If rates fall significantly, lots of people refinance. The high-yielding MBS that Dynex holds get paid back early.
And they have to reinvest that money at potentially lower current rates. Plus, the value of certain types of MBS can fall if prepayments speed up unexpectedly.
It adds another layer of complexity and risk. The margin for error here, as the source puts it, is razor thin.
Okay, absurd payout ratio, net losses, potential dilution, major interest rate sensitivity.
That sounds pretty bleak. It does paint a cautious picture, for sure.
And yet, despite all of that, the source author we reviewed remains interested. Cautiously optimistic, even.
Which seems almost counterintuitive, right?
It really does. So what's the argument for Dynex? Why stay interested with all those red flags waving?
Well, what's fascinating here, and perhaps overlooked sometimes, is the company's resilience.
Their history.
Yeah. Dynex isn't some fly-by-night operation that just popped up. They've been around for decades.
Okay.
They've survived multiple interest rate cycles, hikes, cuts, the works, multiple recessions.
Including the big one.
Including the 2008 global financial crisis, the mortgage meltdown. That was the ultimate stress test for anyone in this business.
And they came through it.
They did. That kind of longevity, that resilience, well, it counts for something. It suggests management might know how to navigate tricky waters.
Fair point. What else?
Also, look at their recent actions. Despite the challenging environment and those losses, they've been aggressively raising capital.
We mentioned the share issuance.
Over $500 million raised just this year alone, according to the source. And crucially, they seem to be deploying it.
Into what? More MBS?
Yes. Primarily into agency MBS, trying to take advantage of wider spreads available in the current market dislocation.
So they're actively trying to grow the asset base.
It seems so. Their portfolio grew by something like 44% year to date. Now, if we connect this to the bigger picture...
That doesn't sound like a company just trying to survive day to day.
Exactly. It's not the behavior of a company circling the drain. It looks more like a company actively trying to scale up, seize an opportunity in a choppy market, and maybe, just maybe,
grow its way into being able to cover that huge dividend sustainably.
That seems to be the bet management is making. And one more thing, the dividend itself.
What about it, besides being huge?
It's actually been increasing. The source notes, it went from $0.13 per share per month in 2024 to $0.17 per share per month now. That's nearly a 20% increase in the monthly payout.
Huh. Increasing the dividend while posting losses and having a crazy payout ratio.
It's bold. The source makes the point. Companies generally don't raise dividends. They seriously think they'll have to cut in 6 months.
Unless they're overly optimistic. Or just wrong.
Or unless they genuinely believe their strategy of raising capital and reinvesting at wider spreads will pay off relatively soon. It's a signal of confidence, at least. Misplaced or not, time will tell.
Okay, so resilience, aggressive capital deployment, portfolio growth, and even dividend growth. That adds some important nuance to the story.
It absolutely does. It complicates the simple trap narrative.
Which brings it back to you, the listener. This is where your own investment philosophy really has to kick in. Our source basically says investing in Dynex isn't really about spreadsheets or nailing the payout ratio calculation down to the decimal.
Not primarily, no.
It's about risk tolerance. How comfortable are you with volatility and uncertainty?
That's the fundamental question.
And let's be crystal clear about who this is probably not for.
Please do.
If you're the kind of investor who lies awake at night checking stock prices, worrying because one of your holdings dropped 10%.
Dynex is not for you. Absolutely not.
This stock can swing. The source calls it a pendulum. Share price volatility is part of the deal.
And if that dividend does get cut, or even just rumored to be cut,
expect the stock price to take a significant hit. It could tumble. You have to be prepared for that possibility.
Exactly. But if you are comfortable taking on that higher level of risk,
in exchange for that very high monthly cash flow,
then Dynex might have a place. Might.
But not the whole portfolio, right?
Oh, God, no. Definitely not. The source suggests thinking about it as maybe a slice, a smaller speculative position within a diversified income portfolio.
Okay, so position sizing is critical.
Absolutely vital. Maybe you hedge it with safer, lower-yielding income names. Maybe you reinvest those big monthly dividends to compound your potential gains, knowing the risk.
And you fundamentally accept that one day you might wake up, check the news, and see that the dividend has been reduced or suspended.
You have to accept that possibility going in. If it happens, hopefully you've collected enough income along the way to make the venture worthwhile on a total return basis, and then you move on.
So if someone is considering this, what are the key things they need to watch closely?
The source lays out a few critical signposts. First, obviously, earnings versus dividends. Does that gap start to close?
Or do the losses continue or worsen?
Exactly. That's number one. Second, keep an eye on that ATM issuance, at the market share selling. How much dilution is actually happening?
Is it manageable or getting excessive?
Right. Third, the macro picture. Interest rate trends. A stable or ideally falling rate environment would be a huge tailwind for them.
Higher for longer is the headwind.
Definitely. And finally, watch their book value per share. Can they maintain it or ideally grow it?
Why is book value so important here?
For REITs, book value is a key metric. It reflects the underlying net worth of their assets after accounting for liabilities. Stability or growth in book value suggests they're managing their portfolio and leverage effectively, even in a tough market. It's a crucial health indicator.
Okay, that makes sense. Earnings versus dividends, dilution, rates, and book value.
Those are the dashboards to watch. You know, the source uses a great analogy.
Thanks,
Dynex is like that friend who always shows up to the party with expensive champagne, dresses well, seems to be living large, but never seems to have a steady job. You love having them around, enjoy the champagne.
But you're always kind of wondering in the back of your mind, where is the money actually coming from?
Exactly. That's Dynex. High yield, attractive payout, but persistent questions about this sustainability.
That really captures it perfectly. That mix of allure and unease. So let's try to land this. At the end of the day, is Dynex's 16% dividend a gift or a trap?
And the source's honest answer, which I think is the right one, is honestly, it's both.
Both? How so?
It's potentially a gift if you go in with your eyes wide open. If you understand the mREIT model, acknowledge the risks we've discussed, size your position appropriately.
Check out Bet the Farm.
Exactly. And you basically ride the wave while it lasts, collecting that high income.
Okay, that's the gift scenario. When is it a trap?
It's a trap if you blindly chase that 16% yield without understanding why it's so high. If you ignore the red flags, the payout ratio, the losses, the leverage, and assume it's as safe as a treasury bond just because the dividend has been consistent lately.
That's when you can get caught out if things turn sour.
Precisely. The source author's personal approach essentially was to take a small sip of the champagne, enjoy the monthly payouts, but metaphorically, keep my shoes by the door. Be ready to leave if the party turns ugly.
A disciplined, risk-aware mindset, then.
That's the key takeaway, not just for Dynex, but for any super high-yield investment you encounter.
So what does this all mean for you, the listener?
Well, ultimately, this deep dive into Dynex really forces us to confront a fundamental question in investing, doesn't it?
Which is,
What's your real risk tolerance? Not what you say it is, but what it actually is when faced with something like this. If 16% just sounds too good to be true,
maybe for you it is. Trust that instinct.
maybe it is. But if you can stomach the potential volatility, if you take the time to understand the business model, the spreads, the leverage, the risks, and you commit to keeping a close watch on management's moves and those key metrics, then Dynex just might be one of those rare, albeit risky, high-yield plays that could reward the bold, at least for a while.
It forces you to look past the headline number.
Absolutely. The real deep dive here maybe isn't just about Dynex financials. It's about asking what an investment like this reveals about your own investing philosophy and comfort level.
So the author remains cautiously optimistic, willing to watch closely.
Cautiously optimistic, yes. Taking the yield for now, monitoring the risks, and basically letting Dynex prove whether this 16% is just a temporary flash in the pan, or perhaps the start of something genuinely remarkable against the odds. Time will tell.